But if you look at the data right now, it's not looking that great. I mean, the rupee is at a record low, trade deficit is very high, there is pressure on the fisc, global debt levels are alarming. Do you think all of that will come to boil at some point in 2026?
These kind of situations, yes. It's kind of difficult what one needs to do and which country you want to play. Amongst all of this, I'm making a point that our macros compared to the US macros or Chinese macros or Japanese or Europe, we are looking far more better. The only thing is the rupee depreciating.
So how does one approach the new year?
I think in this kind of a market, it's not too much about index now. In this kind of a market, it's going to be about fund manager skills or stock picking skills. Stocks will make money or stocks will protect your money from depreciating. My only point is, and what I also hear from my interactions with Ramdoji also, is that we should keep our hawk's eye on the earnings. See, eventually what we are saying is that growth is equal to return. As long as your companies are growing their profits, the price will follow. It may come earlier, it may come with a lag, but it will make up for the growth the business is doing. So focus on the growth at this point of time. Don't focus too much on the price.
So for that young viewer who is still starting out on their financial freedom journey, what do you think is the best way to become financially independent from say 20 till the age of 40?
So usually what happens, we earn money, we spend whatever chiller is left, you invest, right? What Buffett says is that whatever you earn, you put a fixed amount in savings, then whatever is left is what you spend.
But the common argument is that why should I save in my youth and then, I'll turn old one day and then, what's the point of saving all that money?
You have to say that you want to live rich or you want to retire rich.
I have one complaint. As a Motilal Oswal investor for the last 10 years in the funds, right? There was a period when most of the funds underperformed the benchmark quite a bit, underperformed your peers as well. There was a period when the PMS also didn't do that well, despite the market doing well. Why do you think that is?
So between 2013 and...
Hey guys, I'm happy to be a part of Zerodha's media network. Together, Zerodha and I plan to bring to you simple yet effective and impactful news and views from the best minds in the financial world. Hey guys, welcome to the Money Mindset and thank you for being here. By the way, it's been 1 year since we launched the Money Mindset podcast. So thank you for every like, every comment, every watch and all the support that you guys have given us. Now the market is in a bit of a fix. There's a lot of volatility and there's a lot of to and fro, global volatility, challenges, etc. So today we've invited someone who's been in the markets for over 20-25 years. Akhil Chaturvedi of Motilal Oswal is with us. Akhil, thank you so much for being here on the Money Mindset
Thank
show.
you, Sonia. Thank you so much.
And you're here on a very special occasion. It's been 1 year since we launched.
Congratulations. Congratulations.
Thank you so much. But your journey has also been phenomenal. It's been over 20 years now in the market?
Exact 25, actually 26 years. Next month I'll complete 26 years in mutual fund industry.
Wow. And how has it been?
It's been phenomenal. I mean, I joined this industry in 2000, 7 January 2000, Birla Sunlife mutual fund. And I think that time the overall industry AUM was about 1 lakh crore or something. So 1 lakh crore to, I think today 85 lakh crores, that's the journey what I've lived through. And I remember at that point of time, index used to be 500, Nifty used to be 700, 800. Index Sensex was about 3,500 to 85,000, right? So it's been phenomenal. Mm-hmm. And industry is also, kind of developed over time. So I remember the first few years, it was all about explaining what mutual funds is all about. Stock markets were considered more as, a speculative thing, more
Satta
about
Bazaar.
Satta Bazaar. So, and at that time we were going through that dot-com boom and then the bust. Incidentally, my first investment was in Alliance New Millennium Fund, which was an IT fund. That was with the first salary I bought that fund, which was the NFO at 10 rupees, sold off at 1 rupee. So that was my first experience in the mutual fund. So yeah, I think over 25 years, it's been a phenomenal journey. I think the industry has really done well.
Absolutely.
And I think it's a tipping point. My bosses used to say at that point of time that you entered a business or an industry which is a sunrise industry. And today I tell my team that we are still a sunrise industry.
You still believe that?
I still believe we're still at the tipping point. If you see the penetration of equities, penetration of mutual fund, compare that to US, compared to any Western developed economy, penetration is very, very low. But over the last 5 years, I think the pace is picking up. Now the investors are really understanding that eventually if you have to compound your purchasing power, not returns, purchasing power, then you need to take slightly higher risk. You need to do meaningful allocation in equities outside of debt, let me put it that way. And they've understood the rules of the game also, that okay, there will be ups and downs. And eventually I think people also believe in India now as a asset class, as a country. So now if you see over the last couple of years, we've been to many ups and downs, more ups, less downs. But whenever the downs have come, we've not seen retail investors really shutting down their SIPs or pulling out of the mutual funds or equities per se. In fact, we are seeing that the flows have been very positive. People are adding more to their SIPs on the downturns than actually moving out. So that's the maturity what we've seen in investors. And of course, combined with all the educational activities conducted through regulators, AMFI, asset management, distributors, I think cumulatively all of this is kind of sustaining the momentum, and that is what has kept our market pretty stable, despite, I'm sure, what we'll talk about, all the volatility we are seeing in the world and in India. Markets are still stable, I would say.
100%, 100%. So, my aim with the show has always been to help people educate themselves.
Yes.
And then take decisions to eventually become financially independent.
Yes.
Because that's what I did with my journey.
Absolutely.
So as we head into 2026, this is a really kind of a precariously poised market, right? On one hand, the headline index is at all-time highs.
Yeah.
But beneath that, stocks are bleeding.
Yes.
So how does one approach the new year?
Yeah. No, so, it's been a little bit of a tough journey, I think, over the last 12 months or 15 months. See, one has to see from this way that if you see the last 5 years, let's start this way, between post-COVID, between 2021 and right up till March of 2024, I think India did phenomenally well. Right, Indian economy grew from $2 trillion to $4 trillion. That resulted into very strong earnings growth across large cap, mid cap, small cap. So you see Nifty 50 companies' earnings grew at 20% plus. Mid caps and small caps grew at like 30-35% plus. And the starting point valuations were very, very low. Right. So 3 years of a secular bull market we saw with no breaks, and it was just making new highs every now and then. So people were making a lot of money. In those 3 years, I think people made a lot of money. Expectations of investors also changed from equities. Now, when you have 3 years of a secular bull run, right, there is a base effect which also plays out, right? Markets kind of tire out. Economy also kind of slew down. Earnings growth also slew down over the last 12 months. So if you see Nifty 50 earnings came to about 6% last year, right? So after great 3 years, I think it's a bit of a rest period. Markets are kind of consolidating, and
taking it easy for a bit.
Yeah, now there are two ways markets can take away returns from you. One is that given the situation, markets can correct. So there can be a horizontal correction 30-40%, and valuations become cheap, and then that is the right time to enter inside for the next bull market. Or markets go through a time correction. So if you see at 26,000 Nifty today, it's exactly similar to what it was last year. So people have not lost money. They've not made money, right?
But people have lost quite a bit of money in mid and small cap stocks.
See, broad basis, I would believe that a 1 year investment in mid and small would be plus minus 5-6% in mutual funds. Typically, I'm talking mutual funds. Individual stocks, of course, could be anything. But at the headline level, it's not like you've lost 20-30% of your capital. You may have take Nifty 500 broadly 4-5% down, right? So, but what is happening now is that the earnings growth, which were slowing down for the last financial year, last quarter numbers have come out very nice. So I think the trajectory for the period of low earnings growth is going behind us, right? So last quarter we've seen Nifty top 50 companies all put together, their profits have grown at about 10%, which used to be 3-4%. And actually mid-cap index companies have done like 30% growth. 30% is a huge recovery. Now, in the last quarter, we've also seen the GST reforms which have happened. I think this impact will come in the third quarter, which is the December quarter. I would believe that we will see another quarter of very good growth. And then finally you will have your last quarter, which will be Jan, Feb, March, right? So we always said, actually in our commentaries last year, that this year 25-26 will be tale of two halves. First half will be depressed and the second half will be better than the first half, and it's actually playing out that way. So as long as you know that the macro side of the economy is pretty okay, right? So your GDP numbers you are seeing, we made an all-time high on GDP. Inflation is actually now hovering around zero, so that's a worry for the government because they want the inflation to come back now. Interest rates we have seen come down by 1%. We have the MPC now, so let's see what decision they make. So apart from, I think, the currency, where we've seen a steep fall, broadly your headline index has been pretty good compared to any other country in the world.
Akhil, a lot of us have confirmation bias, right? Because we have been investors in this market. So we choose to believe that the economy is doing okay, the market will always pick up. But if you look at the data right now, it's not looking that great. I mean, the rupee is at a record low, trade deficit is very high, there is pressure on the fisc.
Yes.
And globally, global debt levels are alarmingly high, right? Across, whether you look at the US, Japan, etc. Do you think all of that will come to boil at some point in 2026?
Actually, which is what you're seeing. In India, we are getting impacted more due to the global uncertainties than the local uncertainty, right? So, like you said, the recent, the yen unwinding which is happening, the carry trade which is coming to an end, which is creating a selling pressure. FII is continuously have withdrawn almost $15 billion from January till date. So that's taken a huge toll on our markets. Now, why FIIs have withdrawn? Not because they don't like India. They have withdrawn because the US Treasury yields are looking very, very high. On the other side, Chinese markets were looking very attractive in terms of valuation. So a lot of foreign capital has moved into China. So the Chinese market also has got re-rated from a 9 PE multiple to today about a 14 PE multiple. At the macro level, you're right that even if you see US, while it's done well, US markets have done well, but the rally has been very polarized towards the AI companies and the tech companies. I mean, if you just remove them, the markets will just fall flat. Now, there is a concern on valuations even in that space in US. Apart from that, US economy, of course, is slowing down. US debt to GDP is pretty high, right? It's almost 140-150%. Now, macros is very difficult to predict, and how US navigates through, how do they bring the growth back, and tariffs also is impacting the growth, right? So if you see the last few numbers, their economy has slowed down from 2.1% to 1.9%, and inflation is inching up, which means that what will Fed do now? Will they cut rates? Will they hold on? Or will they increase? Nobody knows, right? So, in these kind of situations, yes, it's kind of difficult what one needs to do and which country you want to play, honestly. Amongst all of this, I'm making a point that our macros compared to the US macros or Chinese macros or Japanese or Europe, these are the large four large countries or continents you can play. We are looking far more better. The only concern in our market.
What makes you say that?
Like I said, we clocked 8.2% GDP. Great news. We are seeing recovery in the earnings growth. Great news. We are seeing lower inflation. Great news. We are seeing possibility of rate cuts, positive for equities. Great news. The only thing is the dollar, the rupee depreciating. Now, why is that happening? Like you rightly said, because of the tariffs, the exports are slowing down, right? So that is where we are seeing the trade deficit. So import is happening, and then we've had the Diwali season, and then all the marriage seasons coming up. So the import is largely because of commodities, largely because of gold, right? So that is where the trade deficit is kind of coming up. So and then RBI is actually not intervening much to protect the rupee depreciation because they have to take care of their reserves. So there are a lot of things which are playing out apart from this currency depreciation part. I think broadly all parts are looking pretty healthy in India, and that's kind of translating into earnings. And if the earnings sustain for the next 3 or 4 quarters, then markets will try to discount the future. Then they will look at what will happen in 2027, 2028. Numbers will start to come after December for the earnings forecast, and then markets, will discount the future. So I think just little bit concern on the valuations. If we can have maybe 1 or 2 quarters of maybe flat markets, and earnings are accumulating, so the multiples will start to look better. I mean, if over the 12 months you look at small cap premium over Nifty 50 has already come down. The premium is just about 17%. Mid cap continues to be at 50% premium still, but it's backed by growth, right? So I think in this kind of a market, it's not too much about index now. In this kind of a market, it's going to be about fund manager skills or stock picking skills. Stocks will make money, or stocks will protect your money from depreciating, and that is how you will make returns. So I think we say that it is probably time for alpha. So markets will go somewhere, and good fund managers, good stock pickers will largely outperform the market.
So do you think 2026 could be another year of just capital preservation, where all you do is just protect your capital in such a volatile environment? Or do you think that there could be a chance to make money in 2026?
So if you look at most global research houses, talk about JP Morgan, talk about Goldman Sachs, talk about Citi, all of them are making projections of 10 to 15% returns from Indian markets, right? So people are projecting a lakh on Sensex in the next 12 months. So that is what the global research houses are saying, right? I'm just saying that if next year we can clock a 14...
Morgan Stanley has been predicting a lakh on the Sensex for the last 4 years.
Yeah, but I mean that's the job, right? I mean you have to keep tracking data and see that where can we go. We may go, we may not go. Of course, a lot of things are dependent on market ups. My only point is, and what I also hear from my interactions with Ramdevji also, is that we should keep our hawk's eye on the earnings. See, eventually what we are saying is that growth is equal to return. As long as your companies are growing their profits, the price will follow. It may come earlier, it may come with a lag, but it will make up for the growth the business is doing. So focus on the growth at this point of time. Don't focus too much on the price, right? And that should give you the comfort. So I would feel 26, 27 financial year should be a better year than the current year and the previous year, because of all the reasons I'm saying that we feel that the growth will come back. You look at this, our government, because of all these uncertainties, global uncertainties, in the last 12 months have done multiple reforms. First reform they did was in the budget when they increased the tax limit to 12 lakh rupees. Now up to 12 lakh rupees, that's a massive reform from I think 5-6 lakh rupees. There was no tax to 12 lakh rupees, no tax, right? And probably 90% of the people earning salaries would be below 12 lakh rupees, right? So these guys don't pay tax. That's like 1,50,000 crores given in the hands of people with extra money. For what? To spend and to save, right? Because we're a savings economy. But 2/3 of this money will be spent. It is getting spent, right? The second thing is the rate cuts. So your cost of capital is now gone down by 1%. Now you look at your home loans, before the rate cuts used to be about 9.25%, 9.5%. If you want to buy a home today, the EMIs are cheaper by 2%. So the home loans have come down to 7%. So if the cost of capital is coming down, basically you are tempted to spend money. You're tempted to spend money by leveraging. If you want to buy a big ticket item or like a home or maybe a car, you can now leverage and you can spend ahead of when you actually planned. And the third massive reform is the GST reform. I mean, 90% of your goods and services are now in the 5 and 18% bracket, right? And look at what is happening after September. It's a party going on. You look at the auto sales numbers, you look at the TV, fridge, all of these things, the numbers are looking very, very exciting.
But also if you think of it, globally actually we're seeing a kind of a K-shaped economy, right? Whether it's in the US, whether it's in India. On one hand, you're seeing the middle class struggle quite a bit. Cost of living has gone up, job security is not there. And on the other hand, you're seeing India churn out the largest number of millionaires every year.
Exactly.
So when there's a K-shaped economy, don't you think that could be detrimental overall for growth? I mean, you just have the top 1%, top 5.5% of India that's really growing and the rest are struggling.
No, actually, on the contrary, if you see, we've had a very good monsoon, right? The rural side of the economy is actually doing more consumption than the urban side of the economy. If you see all the recent reports, large part of your fast mover consumer good companies are growing actually in the rural economy. You can go and have a look at the data. Of course, urban is contributing, but rural is where you have 2/3 of the population. So, in fact, this year we are seeing more rural consumption than actually urban consumption. You see, good monsoons has resulted into farmers investing. They are buying more tractors. Tractor sales is at record high. What does that mean? It means that that side of the economy is doing well because monsoons were good, inflation is low. So you're seeing more activities in the look at when you're talking about Indians getting rich. Actually, if you go below the top maybe the top 10 cities, you're seeing more millionaires are actually coming out from the tier 2, tier 3 towns because tier 1 is kind of at a higher base, it will grow slow, but more number of new rich Indians, so many businesses which are in smaller parts of India, like Rajkot or Bhavnagar or Surat or Bellary or mining belts, so many places. Most of the IPOs are actually, the factories are there. Most of the IPOs, the promoters are actually in those towns. So we do a lot of alternate business, PMS, AIF, private equity, all of those things. Incrementally, we are getting a lot of more investors from the tier 2, 3 cities in alternate products than actually Bombay, Delhi.
Really?
Yeah. So we are seeing there's a long way to go. It's just the starting point, right? So we are a 1.4 billion people. It will take some time. We are still a $4 trillion economy. US is at $33 trillion economy. China is at $19 trillion economy. So whatever we are seeing there, India is 20, 30 years behind. But we are on the right path. Right, at a base of 4 trillion, 10% nominal growth means you will add $400 billion every year to the economy. Your per capita is doubled in the last 5 years. Per capita has to keep going up. The poor people 15, 20 years back used to be more like 40%. I mean, per capita was less than $1,000. Today we are $3,000 per capita. In 5 years, we'll maybe be 5,000, 5,500. So average Indian who was making 50,000 in the whole year, today is making 3 lakhs in the whole year. Average Indian will make 5 to 6 lakh rupees every year. And the journey continues.
Interesting. Actually, there are many indicators of the per capita GDP picking up, right?
Yes.
One, of course, is pollution levels. Whenever you see other countries that have grown, infrastructure has grown at a very fast pace, pollution levels are very high.
Absolutely.
The other thing is fertility levels dropping.
Absolutely.
India is
which is all happening here.
It's all happening in India right now. Yeah.
So your population growth rate is now sub 1%. Right. So in the next 10, 20, 30 years, the population growth will be far lower than what it has been in the last 60, 70 years. Right. So the population will probably peak out at maybe 1.7 billion people thereabouts. Right. So that coming down and your GDP ballooning. So the compounding of per capita will be much, much faster.
So for someone who wants to start their wealth creation journey now, today, in this extremely volatile environment, where on one hand you have an AI boom and on the other hand you have a job crisis globally and in India, what's the best way to approach the markets now?
No, so basically, I think, like I said, we are still a sunrise country. I would say that a lot of things are happening here, proactive reforms. We are after a very long, actually for the first time, probably after independence, we are seeing broad basing of the economy. So today, what you see is that across sectors, we are seeing multiplication of growth. You've been in the markets for a very, very long time, way back in 2004, 5, 6, 7. It was all about infrastructure companies. It was all about power. It was all about FMCGs or banks. That's it. If you want to invest money in the markets, these are the 4 sectors which are available. And then we went through a very bad phase between 2008 and 14 after Lehman crisis. It was all about defensive plays, pharma, consumer, that 2 staples, and some few large banks. If you're there in that space, you make money. But today, you have broad basing of the opportunities available in the market, right? You have a power sector, which was a very bad sector, today is doing very well. Within that, you are seeing new technologies coming in, and we are pushing more for renewable power than thermal power, right? So that's a new opportunity which is coming up. The Make in India theme, backed by production linked incentive, is given thrust to new sectors, new opportunities like electronic manufacturing services. And then you have so many companies which are doing so well: cables, wires, selectively defense. So manufacturing is a big piece, I would say. Then, thanks to the rising per capita, backed by lower taxes, lower indirect taxes, is basically creating a discretionary consumption boom. So now you have, you can buy a company which is into malls, where there is high-end discretionary consumption, luxury real estate, jewelries, girls will like, hotels, airlines. All of these are where India is spending. I mean, you travel anywhere, the flights are always sold out, right? I mean, if you see the next 3 months, I travel a lot. So the fares, let's say for Delhi, on an average, I used to buy for 5,000-6,000 bucks one way. 5 years back, today it is 8,000-9,000. Room rates used to be 7,000-8,000 average room rate. Today it is 17,000-18,000, right? So the discretionary consumption has become big. And then in the tech space also, between 2000 and 2020 or 23 or 24, for 24-25 years, tech was all about software businesses. It was all about Infosys, TCS, Wipro, coding. We used to talk about coding from Boston to Bangalore, right? But next 25 years is not about coding and all that stuff. Next 25 years is all about cloud computing, IoT, AI, digital businesses. So US have their FANG companies. We will have our own FANG companies, right? We have a couple of them getting are listed and still getting listed. We have one digital IPO which is going on today, right? So that's a new opportunity for next. So the point I'm trying to make is the growth is very broad based. You have multiple opportunities, multiple sectors, multiple themes, sub themes, and with the kind of new businesses which are coming into capital markets to raise money rather than going into banks to raise debt, it creates furthermore broad basing of the market. So now in this kind of a situation, I think today's generation, my son, he's 21, going to be 22. And when I talk to him, I just tell him, boss, you are at the right place at the right time for the right compounding, because next 25 years, I feel for India will be great story. I mean, in front of your eyes, you will see your economy touching $30 trillion by 2050. And if you take market cap to GDP as 100% only, today we are 125%, then our market cap after 25 years should be 40 trillion or 45 trillion. And
is there anything that could come in the way of this compounding
Many
journey?
things will come. It's not going to be like a fixed deposit journey. It's not going to be secular. It's not going to be linear. You will have your ups and downs. We are in downs. We are in a bull market, but bull market comes with its own small phases of patchy phases, where growth slows down. So if you take big picture, looks good. But in 25 years, we'll see everything. I don't know if, we suddenly from out of the blue, you got COVID. I don't know, something like that happens. Where we are in terms of, let's say, US macro, something goes wrong there because of the very high debt, or I don't know what they're talking about. They want to depreciate their dollar. They want to see big picture. If you look at the whole petrodollar concept also is coming to question mark, because now we are buying oil from Russia in the local currency. We're no longer buying in dollars, right? If that's, everybody starts to do all that stuff, and then with the popularization of EVs and all of those things, the dependency on oil comes down. So macro concerns, global macro concerns will be there. Political uncertainty is always there. See, today we are in India, third term stable government, right? Largely non-coalition government. So you can take proactive reforms. So how is the political landscape shaping up? Because to a very large extent, governments decide where the country will head, right? The governments will decide whether the country should go in the growth phase or they should go in the socialist phase or those kind of things. So political uncertainty, I would say, global macros impacting maybe Indian macros. So there'll be bouts of underperformance. There'll be bouts of negativity. There'll be bouts of drawdowns, but stay put.
So you still believe that this is a secular bull market, and within the bull market, there is a corrective phase that's going on?
I would say so.
And you think this corrective phase can last long? Whether it's time correction leading to price correction, you think it could be a protracted period of correction?
See, next 2 or 3 quarters, certainly we don't see any big thing happening out here. Too many things are going on, too many moving parts. But if you tell me 2 3 years down the line, I think things will be okay for us. We just have to watch out on the numbers. Now numbers are in the future, so let's see, when we talk about the GDP, what the number will be for next quarter, then next to next quarter. Is this like a sustained phase of 7% plus real? But now you see the problem in most of the economists after the 8% number which has come up. The issue is now that your nominal growth is not going up.
Correct.
Right? Because your inflation is at 0. So you are at 8%.
Yeah.
Right? Now you need 3-4% inflation for the nominal growth to go up to 11-12%. So these kind of things will keep happening. So next 2-3 quarters, I would say wait and watch. On the contrary, I would say keep accumulating. I mean, every time there is volatility, there is a correction of 3-4-5%. Just keep buying slowly, steadily. Keep some dry powder.
That has been the age-old method of creating wealth. I get it, that buy every dip and buy and hold, buy and sit tight, all of that. But in this market where everything is changing, as you said, right, nominal GDP is not picking up. On an average, this market has given you 11-12% returns in the last 10-20 years.
Yeah.
But if nominal GDP growth is not picking up, then is even that 11-12% questionable?
Yeah. See, if you go very, very conservative, very, very conservative. This is again I've learned from Ramdev only. See, India has done in the last 25 years, India has grown at 9% USD terms, nominal. Right? So adjusted for rupee depreciation, inflation, all of these things, we have grown at 9%. Right? At 9%, in 2000, our economy was $440 billion. At 9%, in 25 years, we are $4 trillion. At 9%, and last 25 years, we've seen everything, whatever you can think of. If you just extrapolate 9% for next 25 years, it's 30 trillion. If we just grow at 9% in dollar terms.
The market, you're saying?
No, I'm just saying the GDP, and everything is connected to GDP.
Correct.
Unless the country doesn't grow, nothing will grow.
But if the market is giving me 9-10% over the next 10-20 years, why am I putting my money in stock markets? I'd rather put it in other asset classes. Just playing the devil's advocate here.
No, so let's put it this way, that let's put a chronology between GDP and then the earnings and then the price growth, right? Now, if you do a 9-10% GDP growth, see, this year is an exceptional year where inflation has come down. Eventually, inflation will come up to 3-4. We are a growing economy. With all this spending happening, I'm sure prices will move up at some day. On a longer term basis, even if you look at next 5 years, I would say we will see a nominal growth of 10-11% at least, translating into a 12-13% earnings. So if your country is growing at 10-11%, corporate India will grow at least 1 or 2% higher than the nominal growth of the country. And if the earnings growth is, let's say, 11-12% or let's say 13%, then the price growth should mirror. Like I said, growth is equal to return. So the price growth will mirror the earnings growth. So even on a 5-year or a 10-year basis, if we can clock a 10-11% nominal growth, which would be, let's say, 7% plus real GDP and 3% inflation, so 10% nominal, we can do. Can result into, like I said, 12% on EPS, and then that will result into 13. So you're still looking at maybe 2.5-3 times higher return in equities than inflation, at least. I would be a strong
domestic growth, I agree, but export growth has been hit a lot because of the tariffs, etc. Right?
And which will get sorted, right? It's not going to be permanent.
Hopefully,
it will. See, we are also not succumbing to pressure. I mean, now let's go from a political perspective. If we just kind of succumb, many countries have succumbed to the pressure, and you give them everything, and you don't take anything, then there is a democracy out here. There is an opposition. There is a ruling party. You have to see that what message you are giving to our country. Will you like it to hear that we have given everything? We'll buy everything from them, and our farmers will be, sitting at home and wondering what to do. So I think we will take our time. We are in a position to squeeze a good deal. So I think let that play out. It's a matter of time. It was supposed to happen in November. People now talk about Christmas. Maybe it will take 3-4 months. I don't know. Till such time we are going to suffer. Till such time we will suffer. And that suffering will create opportunity. It's not going to be lifelong. It's not that we are. I mean, US also needs us, right? They import almost $80 billion from us. So they also need good products, and supply chains are getting set up here. I mean, you have Apple, which is supplying 30% of the global supply from India. It's not going to vanish away. right? So they're dependent out here. But yes, whatever time it's taking, but eventually it will be sorted out. And let's hope that it is a nice deal, beneficial to both the countries. Let me put it politically correct, So it will happen, and the moment it will happen, see, things will change. The day the deal is announced, maybe you'll see a 2-3% appreciation of the currency there and then. Now, will you plan for it before or after it has happened? Right? Suddenly things will start looking, suddenly your export numbers will go up, suddenly your trade deficit numbers will come down, current account deficit will ease out. That will have good impact on the export companies. Macros will start looking much better than what we are seeing today. So now it's up to you whether you believe that will happen or you will not believe. Acha, chalo, even if it doesn't happen, then something else will happen. I mean, we will have to do something to take care. I think government is coming up with some relief mechanisms or some extra incentive for the export companies. Reforms for export. Let's see what happens there. There are many countries which are backing us. I think we have the Russian president out here to see that how trade can be improved. There's hardly any trade we do apart from importing oil. If you see export is hardly anything. I think maybe about $10 billion or something like that. Can we take that up? The ties between India and China has improved thanks to all the tariff and all of those things which are happening. Our ties have got better, right? So something will happen in terms of the reorderization of the global trade which happens, right? But still, US is large. We need US. US needs us. We need to have a good deal in between.
That concern is there for sure. But do you think this whole story of India becoming a manufacturing hub of the world will remain a pipe dream? Because it's something that has been on, the talks have been on for a while, but somehow it's just not getting there. And forget about being a manufacturing hub for the world. I mean, now most of the companies are, just about producing for, in terms of quality, in terms of efficiency, just about producing well for India. Why do you think that is? Why has India fallen back so much in the global manufacturing landscape?
I think the focus was never there on manufacturing. I mean, you see last 2 or 3 decades, no new plants,
But it's been over a decade now that the focus has shifted to manufacturing, right?
Yeah. So, I mean, okay, so even if you talk about the recent past, I think a lot of front loading has been done by the government, right? So they've been spending ₹1 trillion every year, giving confidence to private sector that, set up new plants, set up new capacities. They know that manufacturing is very, very important for our economy because that also creates employment that will strengthen the backbone of the economy. So you see there are 2 or 3 reforms which happened. One, they cut taxes. Corporate tax has been cut from 35% to 25%. Means extra cash in hand of companies to reinvest in the business. Why was it done? Basically, to give confidence that go out there and spend money or build capacities. If you create a new factory, then the taxes go down even 10% down to 15%. For startups, they're giving zero tax up to 3 years. So this is all the tax reforms they have done to give confidence to the private sector. Right, the production-linked incentive schemes now running into 12 sectors. Right, that is extra incentive for the goods you manufacture, and you get extra revenue through the government incentive scheme. That is also to push manufacturing, right? And then government spending 10-12 lakh crores to build roads, ports, airports, metros. That's. I mean, we've seen good infrastructure coming up, right? You should travel sometime. Honestly, you should go for a Bharat Yatra. See, I do
actually. I travel a lot with work now.
Yes. So how do you find, let's say you go to the tier 2 towns, go to Bhubaneswar.
So recently I went to, we went to Mathura.
I'm from Mathura.
Yeah, I know you are from Mathura. Yeah, we went actually to Vrindavan for a shoot.
Yes.
And the Yamuna Expressway I went for the first time.
You had with
Manish.
Yeah.
It was fabulous.
Good interview. Yeah.
Thanks.
Fabulous, right?
The roads.
Vrindavan has changed. Vrindavan, just the mandir wala part, leave it alone. It's too claustrophobic out there. But outskirts is all the Marwadis and Gujaratis have changed the landscape out there. The buildings and the roads and
a lot of developers coming now.
We have Taj Hotel coming out there. I think it's come up. I don't know. So,
but I was quite pleasantly surprised to see the roads. Definitely. I mean, it was my first time on that Yamuna Expressway.
Sonia, is still better. You go to Mathura. I've seen Mathura from my childhood days. Right, we go there every year. uh, sanitation, electricals, roads. And it was a complete mess. We used to hate going there in the summer vacations, right? Today, it looks very different. I mean, we used to have all those electric wires hanging around outside our homes. People used to take our light and put in their light, that kind of stuff. In the last few years, all those things have gone underground, right? There are electric meters outside our home. We used to never pay electricity bills.
But
Now
a
there are
lot more
electric
can
meters.
still be done, given that it
Of
is
course.
the spiritual
See, that's what I'm
capital.
saying. That is the opportunity. That you have so much to do. So till such time you continuously keep developing, things are going to look good. Economic activities will be very high, right? So I mean, let's say you look at airline. Now look at US. We are a large country. US is a large country. China is a large country. US has what some 6,000 aircrafts. We have maybe 600, 700 aircrafts. US has airport even in small towns. I went to US a couple of months back to drop my daughter. I went to this little island. I'm missing the name in Cleveland. Small island, no cars out there. So you go by ship or you go by boat, and in that island, basically you have the buggy cars. So you travel that island you rent a buggy car and travel around. That small island also there was an airstrip. So all the rich Americans actually they take the charter plane and it's like summer place. So there are a lot of nice bungalows. Now India though is just coming up, right? So how many airports can we have? How many aircrafts can we add? And we've seen so many orders. So that this runway to growth, runway from our prime minister says that from a developing country to developed country, that 20, 30 years of runway to growth is the opportunity. Won't be secular, won't be all goody. In between, you'll have patches. Risks are there. But for that risk, you get a premium in terms of returns.
Because even if you look at tourism, right, since we're talking about tourism, I agree there's a lot of development. But even if you compare India to say smaller places like a Vietnam or a Sri Lanka,
it's nothing.
Places in Africa, places in Russia, India is
nothing.
very
and we have so much to offer
compared to here.
We have so much to offer. But because of infrastructure, because of safety, security, I think still. I mean, I was reading actually. I think this time around, Bengal has seen maximum international tourists because of the Durga Puja. It's been put on the international festival list, something like that. I was reading in the paper. But you're right that our tourism is still a little messy.
A lot more work needs to be done, honestly.
Definitely. See, when you travel and when you go abroad, like places like Sri Lanka also, we did our recent offsite out there. It's pretty developed. It's pretty okay.
One would not expect.
Facilities are good. Out here is a little disorganized.
It is.
Right? We are used to it, but imagine somebody coming from outside here and you get out of the airport and from there only the journey starts. But I think tourism will this industry will take some time. I think it will take some time. And there has to be something to be done. To ensure that, I mean, of course, this government keeps talking about. So you see the way the Ram temple has come now. You see in Ayodhya, almost 100,000 people visit every day out there, right? So domestic tourism is moving up, and domestic tourism is also expensive now, right? International tourism, I think, will take time. Still, you get tourists in maybe Rajasthan or Kerala. I don't think anybody comes to Maharashtra for tourism, but they'll go to maybe.
Goa has also reduced a lot.
Goa has reduced quite a bit, I think. Yeah, but I agree with you. A lot needs to be done for international tourism.
Okay, so we've spoken a lot about the economy, but now let's talk about how to make money, right?
Yes.
You have a very interesting report called the Nifty to Sensex in the next 10 years.
Yeah.
So you're saying that the Nifty will go from 26,000 to 86,000 in the next 10 years and can perhaps do better than that.
Yeah. So it can go. It will, I don't know, but it can. Probability is there that Nifty, which is today, let's say 26,000, can be today's Sensex, which is 85,000 thereabouts. Can be. So putting that in context. So this was just a presentation which I was just thinking on some data line just to think that, okay, how can the next 10 years look? It's all Excel sheet work, right? But then I try to build in some chronology in this, that if this happens, why will it happen? And if this can happen, then has it happened in the past, right? So keeping all of these things in mind, me and my team, we just sat and started working on numbers. So now let me first explain to you in a simple way. From the time Nifty got incepted, somewhere in 95, 96, so about 30, 35 years, Nifty total return has been 14%, and X of dividend return has been about 12%. But let's take the total return from calculation perspective. So if I just kind of say that, okay, whatever has happened in the last 30 years, if you just take the same compounding for the next 10 years, then what happens? So if you compound 14% from today's level, let's say 25,000, 14% means roughly 5.5-6 years you double, right? So in 10 years, just the simple 14% compounding mathematic will take you to about 82-83,000 by 2035. Just 14%, what has happened in 30 years, if that repeats in the next 10 years, then you're looking at 82,000, which means that today's Sensex is 82,000 and Nifty will be 82, 83, 85, plus minus, whatever it happens. That's a simple compounding of 14%.
But that's the assumption that things will repeat.
It's an assumption. Now you say no, it will grow at 12%. So maybe it will be 77,000. 76,000. You will say no, it will grow at 9% only. Then maybe it will be 68,000. But certainly it's going to be higher than where we are today. Matlab, you will make returns, right? Now it's up to you. What you want to, you're conservative, you want to take 12%, you want to take 10%, I leave that to you, right? I've taken 14%, whatever. I'm just taking data from the past. And, they say that history does not repeat, but history rhymes. So I'm just saying if it rhymes, probably this is the number. But just take a broad understanding. Now, so what we thought was that what has happened in the past, let's look into that. What happened in the last 10 years and then what happened into the previous 10 years. उसके पहले देख नहीं सकते because 95 में born हुआ था, तो you don't have full data there. So what we saw was, now note these numbers, okay? First we saw 2004 to 2014. 2004, Nifty was it was 1700, right? And that time Sensex was about 5,500, 5,000-6,000. 1st April 2024. I'm taking financial year. 2004 to 2014, 1700 Nifty ended at 6,500. And like I said, the starting point of Sensex was 5,600. So very close to it. Actually did better than Sensex, right? 1,000 points more than the Sensex. So it has happened between 2004 and 2014. Then we took the next 10 years, 2014 to 2,700. Now the 24, sorry. So the opening level is now 6,500 for Nifty. At that point of time, the opening value of Sensex is 22,300 thereabouts. 2024 just passed by last year. What was Nifty? 23,000 something. What was Sensex at the start? Actually, there's a difference of 200 points. Okay, now let's go back in 2004 to 2014 and let's look at some numbers. Basic numbers. I will not go into deep numbers. I can share with you later on. So what we saw, so this was a compounding of 14%. In that 10-year period, 2004 to 2014, Nifty compounded at 14%. Sensex had compounded at 15%, plus minus 1%. So like we have been discussing that there is a close correlation between earnings growth and price growth. So we saw the 10-year EPS growth for the Nifty 50 companies. The starting EPS was 130 rupees for the top 50 companies. 130 ka EPS tha. The closing EPS was 401, right? So that was compounding at about 13%. The EPS compounding was 13%, led to the price compounding of 14%. Growth is equal to return. Keep that in mind. Now, why were the companies doing well? Like again, we have been discussing through the interview that there is a close correlation. Economy has to do well, then the corporate India will do well, and then the market price will go up. So we went into the GDP numbers. So our GDP was $440 billion, which I told you in 2004. It ended at $1.89 trillion at the end of 2014. Okay, so $440 billion GDP going up to 1.89. This was a compounding of 16% nominal in dollar terms. But if you refresh your memory, in that patch 2004 to 14, the real GDP was about 8%, but inflation used to be very high. 10% का inflation होता था उस time पे. तो 16% का nominal growth chala. So 16% took your economy from 400 to 1.89, right? So which was a growth of 16%. So economy growing at 16%, corporate India growing at 13%, price growth at 14%. Now you see the numbers are just like 1-2% plus minus, right? Ab usi phase mein see some more numbers. Total profit made by all the listed companies, all not 50, all the listed companies in 2004 was 1,30,000 crores. सारा कंपनी को आप जोड़ दो प्रॉफिट आफ्टर टैक्स. This ended at about 4,30,000 crores. So 1,30,000 crore का total profit went up to 4,30,000 crores, and corporate profit to GDP was about 4.5%, right? So that's how what happened in that phase. And उस phase में Sensex hit the first lifetime high of 21,000 just before. First time Indian economy became a $1 trillion economy in 2007. So much happened when the economy was doing a 16% growth. ठीक है ना? तो ये सारे numbers you have understood, but basic GDP growth 16%. Corporate earnings growth 13%, price growth 14%, Nifty became Sensex. 2014 to 2024. Now, at that point of time, the GDP growth slowed down to 7%.
Yeah.
Right? So, largely the inflation came down. There was a currency deflator because rupee depreciated at that point of time. But we saw only a 7% growth on the economy. Right? And that took our economy from 2014, 1.89 trillion to about 3.8 trillion last year. Right? So just a 7% compounding over the last 10 years. And the corporate earnings growth also slowed down because the economy slowed down. So the corporate earnings growth came to about 12%. Right? And the price growth was 13%. Still Nifty became Sensex.
So despite a slowdown, we've seen Nifty become
7% का GDP था, but आपकी earnings growth भी 1-2% से स्लो हो गई. तो आपकी प्राइस भी 1% से स्लो हो गई. सो 2004 और 14 के बीच में क्या हुआ था कि निफ्टी डिड बेटर देन सेंसेक्स, बट बिटवीन 2014 एंड 24 निफ्टी एंड सेंसेक्स वाज ऑलमोस्ट इक्वल. उतना फर्क पड़ गया. दैट्स द ओनली थिंग. नाउ यू डू दिस फॉर द फ्यूचर. जो मैंने आपको बताया कि 14% अगर आप अज्यूम कर रहे हो, 14% ग्रोथ, then we are assuming that economy will do 10 or 11% nominal growth, which will result into 12-13% of EPS growth, and which will result into 13 or 14% of price growth. Data को expand कर दो, we'll be somewhere around these levels of Sensex. Bound to happen. Something has to be really messed up for this to
not happen.
Not repeat. Now, kabhi sitting out here, you are also thinking, when I talk to people, they are also like blank, मतलब कोई reaction ही नहीं आता है कभी भी. But had I told you this 10 years back, ये होने वाला है ऐसा, तो now you'll think a little differently. So thinking
actually compounding na as a concept is very hard for people to digest. Even people who capitalize
2-3 साल
on
के
it.
आगे सोचते नहीं है ना हम. अभी क्या सारे क्वेश्चंस आप जितना whatever investor seminars I do, all the question is एक साल बाद क्या होगा, एक साल बाद nobody knows what will happen in एक साल.
और आप किसी को बोलोगे ना 8+8+8 करने के लिए तो उनको आंसर पता रहेगा. But if you tell someone to do 8 into 8 into 8, they'll suddenly just lose track.
तो
right?
formula you interviewed Ramdoji recently, right? And he was giving his compounding numbers like we've learned a little bit from him. He's far way ahead. But 1,000 times at 15% can be done in 30-35 years. You can actually, but thinking that, there's this interesting terminology used in this by this author called Thomas Phelps. He talks about vision, courage, patience. Again, Ramdoji has learned from him only. The vision part, is thinking 10 years, 15 years, 20 years. When you want to create wealth, and you've interviewed a lot of successful investors and fund managers, all of them have created a lot of wealth, but they've created over 20 years, 30 years, 40 years, right? But it's been a compounding of 14-15% only. But utna saal wo vision hona bahut zaruri hai. So once you have vision, then you have to have courage to buy. And when you have courage, then you need to have patience to hold. And as the author says, patience is the rarest of three. Patience nahi hai.
So what do you think is the one thing that sets successful people apart from unsuccessful people?
Conviction, belief, vision, like I spoke about. I think these are things. Conviction, and I think that is very, very important. Like,
conviction in yourself or in your idea?
Conviction in everything. In conviction in your belief that, let's say you're betting on India as an asset class. Then what is your conviction about India for the next 10, 20, 30 years, right? If you want to invest outside of India, then let's say you want to invest in China, then what is your conviction about China? How much do you understand that country? How much do you understand the growth journey of that country? What all can happen, good, bad, ugly, whatever. And then you play it out, right? See, before any sport starts, let's say cricket, all the players will go down on the pitch and they will see that how the pitch is and all of those things, right? And then they make a strategy around this. So you need to have the belief on on the numbers, on the data, on the reforms, on the growth, then can you bet on something. Before betting on something, you need to have conviction, you need to have belief, you need to have understanding, and you have to be agile.
But sometimes it's also faith, right? Because you don't know which way things are going to go. Like, for example, you're assuming that the GDP growth will be about 5-6% and this will continue for the
Yeah.
next 10 years.
Yeah.
You're assuming that corporate growth will
Yes,
pick up.
yes.
You're assuming that reforms will come through. So a lot of
Yes.
it is faith related
Yes.
also.
हाँ तो faith बोल लो, belief बोल लो. Faith is also belief in a way, ना. I mean, see Rakesh Jhunjhunwala, if you track him, all of us have grown up listening to him, right? Go back to his interviews 30 years back, and then 20 years back, and 10 years back, right till he passed away. He's always been very bullish on India, and it has played out. And in between, I mean, we were not a large country. We were more messy than we are today. We had more issues than we have today. We had so many issues. In that, there was this guy who was betting on India, and it played out. From nothing, he became 50-60,000 crores, right? Just equities. Look at Buffett. Like, US has never been great from the time it was born. US has seen multi-time recessions in 1930s and 1970s. They have seen multiple times recession, right? The Lehman crisis at 2007-8 is also recession. But somebody like a Buffett has been invested across all time frames, and he always says, if you remember in his one of the Berkshire Hathaway AGM, I had gone there, and I think in 19, he said that don't bet against America. Right, so that is his belief, that is his conviction. So 99% of his money, or maybe more than that, is actually in US. It is not in India or China or Europe. And few investments here and there he would have done outside of US, but he's bet on the single country, and he's made money after going through all ups and downs. So if you talk me personally, I have a lot of belief, a lot of faith that this country will be the next. If you have to become a next major power, then you have to participate, right? There are risks. Like I said, it's not going to be a one-way journey. There are going to be ups and downs. But do you believe? If you tell me believe in this country for next 12 months, maybe I'll be moderate, right? If you tell me to believe for 10 years, I'll be excited.
So what's been, since you've been in this industry for over 25 years, at the helm of Motilal Oswal Asset Management for like 13, 14 years
13
now.
years, yeah.
13 years. What's been the biggest lesson that you've learned through your journey?
Tons of that. I had no understanding of equities. Before that, I was a pure salesman. I can say that I'm a knowledge-based salesman. I think knowledge is very, on the surface, equities look very easy. But beneath the surface, there are many things which play a role. To understand equities, to understand business. I used to not even understand what earnings is all about. Actually before maybe 15 years back or something like that. So I think knowledge part is something which I've gained quite a bit. Lot of learnings as an investor from our chairman Ramdevji also, and he's very kind. He likes to share wisdom. So practically I've heard him so much, I can guess what he's going to speak next time. Some new insights will come, but largely I know what he's talking about. Yeah. And I think what we have learned from him is that, what I'm saying is that, do simple stuff, simple investing, stay put, invest whenever you have money, redeem when you need money.
But I have one complaint. As a Motilal Oswal investor for the last 10 years in the funds, right? There was a period when most of the funds underperformed the benchmark quite a bit, underperformed your peers as well. There was a period when the PMS also didn't do that well, despite the market doing well. You're nodding your head, so clearly you agree with that. Yes, of course. Why do you think that is, and how have you changed?
I was at the forefront to get all the bashing at that point of time. Yeah. So see, our journey. Real journey of building our asset management business started in 2013. We were all of under 1,000 crores of total assets then. And we started to build up because we had a track record, we had our philosophy in place, processes, QGLP you would be knowing. The first 5 years were great years because the way we were thinking, wherever we had conviction, we invested, we made a lot of money. So between 2013 and till 2018, our funds used to be right on the top. And that led to growth of our AUM from, let's say, 1,000 crores to, we peaked out at 40,000 crores. Now, see, in an investing journey, fund managers, asset management companies also go through cycles. It's never a linear cycle. So they will have a 3-4 year of great cycle, then 2-3 years of down cycle, consolidation, then some changes will happen, and then the fund goes then they start to go back on the top. Any fund manager, you can pick and choose anybody and see the journey, right? Everybody goes through ups and downs, and if you remain invested through the ups and downs, you make a CAGR of 14, 15, whatever that number comes over the longer term period, right? In our case, we had a certain style, largely we were buy and hold investors, but the markets had changed. The buy and hold style was not playing out. So we started making changes in our philosophy. So from buy and hold, buy right, sit tight, we used to say we are a lot more active investors. The activity in the portfolio, which used to be like less than 10% then, today probably would be more like 40-50%.
The churn, you mean?
The churn ratio. We worked very hard on new ideas which can make money tomorrow, buying them as early as possible. Our focus on growth and understanding of growth became a lot more sharper. Like we have been discussing, that growth is equal to return. So where will the growth come? Which sectors? Which themes? And if you can identify that as early as possible, you get the benefit of good returns coming from those companies. So we worked a lot on the understanding the growth of sectors and businesses, and all of that actually. And we also invested in the team. Right, we used to be a small 5-member, 6-member investment team. Today we are close to 30-member investment team. We have 13 fund managers. We have 9 analysts. We have a 3-member risk team. So we have invested a lot it's like investing a lot in the engine of the car. Because the first thing you see in the car is the engine. So in our asset management, it is investment team. So we have invested in a lot of new talent, a lot of homegrown talent. We got leadership, sorted out. We got Pratik Agarwal from ASK, comes with 33 years of experience. Then we have, of course, Ramdoji. So people level changes, process level changes, policy level changes, portfolio level changes, everything resulted into performance changes. So fortunately, over the last 3 years, we have not only recovered, of course, we've done well over the last 3 years, but we've also recovered all the underperformance of the past.
That's
The same mid-cap fund today is a darling of the market. Our own mid-cap fund was 43rd out of 43rd 4 years back. 43rd out of 43rd.
I was an investor in that fund, I know.
But had you stayed...
Painful.
But that's the patience part.
I didn't know you that time. No, I was out of state.
Yeah, but you could have spoken to Ram. You have access to Ramdev Agarwal. You could have spoken to him. He stayed back, right? And from 2021 till... so the bad phase was 19 to 21. After that, I think the bottom NAV was 22, 23. Today it is 100. That 2-3 years of bull when it comes into a fund, it takes care of everything. Today,
but it's interesting that you guys changed your strategy,
yes,
because which
is what I liked out here. Honestly, I worked in 1 or 2 more firms. I'll not name them right now, but compared to them or compared to what I see in the industry, I think we are open to change. Our promoters, and that is what gave me a lot of confidence in that patch, because we were seeing the changes happening. We were seeing people changes. We were open to buying a lot more, diversify our portfolio. Our comfort in many sectors was zero. We used to say openly that we will not do this, we will not do this. Today we are saying never say no to anything. Like buying a loss-making company was completely no. Today we have benefited by buying some companies which have bought in losses and now moved into profits. Right? So we are very open, very broad-based, very diversified, open for ideas, whichever sector, power hoga, infrastructure hoga, digital business honge, koi bhi ho. If we understand the firm, we understand that how the P&L will move over next few quarters or next few years, we are very open to buying that as early as possible. There is where you get the PE re-rating benefit. On that point, let me also tell you that market PE multiples also keep expanding every 10 years. Yeah. I forgot to give you this point. 2004, our markets used to trade at 13. That was the normal. 2014, it became 16 and a half times, 17 times. Today, it is 22 times. Right. So the PE multiple also keeps changing every 10 years. It keeps getting re-rated.
Okay. So last 10 minutes of the conversation, it's been really a fun conversation. I've learned so much from you. Thank you so much for being here.
Thank you.
But last 10 minutes, right? For someone who is, and of course the main crux of the conversation was around the fact that the Nifty could turn into the Sensex in the next 10 years. So for that young viewer who is still starting out on their financial freedom journey, give us like a 4-step routine for investing.
Yeah.
What do you think is the best way to become financially independent from, say, 20 till the age of 40?
Yeah, no, I think the opportunity is out here. I would say I would take a clue from what Buffett says. Uh, so you earn money, income, then should be savings, and the spillover should be expenses. So usually what happens, we earn money, we spend whatever chiller is left, you invest. Right? What Buffett says is that whatever you earn, you put a fixed amount in savings, then whatever is left is what you spend. So I think in your initial years, you have the advantage of 30-40 years to earn money, retire, and in between you can take a lot of risk also. So in the early years, unfortunately, I could not do that. But in the early years, if you can invest a lot, right, and spend very, very little, I think subsequently over 10-20 years, you'll be able to spend a lot and still not compromise on savings, right? So the first 10 years, one has to compromise on not buying that tempting car or that tempting house, or buying branded clothes, or spending a lot on food and mobile phones changing every year. This is the pattern of the young people. If you can control that and live a humble life and save a lot of money, right? And just that compounding again, it will take care of. So I would say that whatever you earn post-tax, put 30% SIP, and the rest you do whatever you want to do. I'm still giving 2/3 to spend.
But the common argument is that why should I save in my youth and then, I'll turn old one day and then, what's the point of saving all that money?
You have to say that you want to live rich or you want to retire rich, right? If you want to retire rich, then you have to compromise somewhere. See, either you compromise in your later years, because see what happens the moment you cross 40, right? I crossed 40 and then suddenly a lot of alarm bells started to ring because my kids were coming into higher education. So one of them wanted to go abroad. So suddenly you're seeing several crores which has to be spent, and then within that time frame you will have also the marriages coming in, and then I have to take care of me and my wife once everything is settled, right? So after 40 a lot of bells ring. I'm sure it will be you're young, but it will start ringing at some stage. So that time now you have only 15 years to compound, versus if you can think of all these things from our experiences and start early, then at 40 you will know, maybe you'll retire at 40. So I think early days, and fortunately our generation, at least probably till your generation, things were not as good. I mean, our parents have lived a very average life, small homes, one car, small stuff, right? Today's parents are a lot more financially secure. Homes are, I mean, if somebody has a home, a new kid has a good home to stay and doesn't need to spend for ration, right? तो बच्चा क्या करने के लिए? आप कितना खर्च कर लोगे खाने पीने पे, कपड़ों पे, सब चीजों पे, राइट? घूमने फिरने पे. So I think a large part of expense. I started working, I had to take care of a lot of things. I had to start giving my mom, I had to plan for the next home, I had to plan for my wife. We got married also, then the kids came. So it's been on a treadmill. For the today's generation, that's not so much of a pressure. For some who don't have anything, unfortunately, they have to do a lot more planning, lot more better planning. Net, Sonia, what I'm saying is that just invest well in your early years. It is easy to do in early years, difficult to do in your latter years.
So what should the fund investment pattern be? I mean, since you're heading the asset management business, I'm asking you, how much should go into passive investing, how much into active investing, how much into direct stocks? For a young investor, what's your recommendation?
You start with passive, start with a Nifty 500. It gives you a good broad-based exposure to large cap, mid cap, small cap. Very good index, done very, very well. It gives you tadka of mid and small, so higher return than Nifty 50. For initial 2-3 years, get used to the volatility up and down, and as you start understanding what equities is all about, then you can start to track active mutual funds, and then go on to maybe a mid cap, small cap. All of those things you can do in your first 10-15 years, higher side. So if possible, in your very, very early years, you should be 100% equity, or maybe at least 80% equity, at least. वो classic formula है, 100 minus 8 should should be equity. Just follow that formula. So if you're 25, 100 minus 20, 75 to equity rakho. 75 equity mein maybe you can be 50% Nifty 500, 25% you can buy 2 or 3 active funds. I'm talking about the initial 5-10 years till you're getting comfortable. And then as you get expert, you start changing your pattern, and you can decide what. But the starting point should be Nifty 500 before jumping into small, mid, and then then you'll get scared. You leave the journey and go. Like when I started investing, 3 times I became bankrupt.
Really?
So my early days, regulations were not tight. I used to do future option, became zero. Then I bought one of the IPO, which was a last top IPO of 2008. You can figure out the name. Again, zero.
Everyone got into that
After
one.
that, 2008 के बाद में फिर मैंने वो SIP किया. I'm sitting peacefully talking to you. I work out well, I work well, I sleep well. SIPs, and whenever bonus, simply just put in mutual funds. If you're lucky, you can understand stocks. You want to go buy there 2, 3, 4, do that. But otherwise,
But it's interesting, you've gone through that journey
Yeah,
where you've done FNO and you've done direct stocks and lost all your money.
We can have one more episode on that, what all the mistakes I've done. I bought into real estate, on giving just simply on interest, but that I recovered thanks to RERA coming in. But I went through a painful journey because simply gave to a builder on a allotment letter and on a fixed interest. So, and anything which is.
But even I did that, by the way. Even I lost a lot of money in real estate.
I recovered. Only my one investment is pending. 2 I've recovered. 1 thanks to RERA, thanks to government for that. So, and this is what Ramdev ji taught me early on. That पहले उसको बाहर निकाल दो. ये जो कचरा करके रखा हुआ है ना. He says कि आप इक्विटी में डालो, ऊपर है नीचे जो भी आपको कल पैसे चाहिए कल आ जाते घर पे. T+1 कभी कभी, अभी तो T+0 पे बात चालू है. और इधर तो फंस गए आप.
Real estate.
Yeah, real estate, और उसके अंदर भी if you do stupid things, then don't do stupid things basically. And when you're young, you want to do a lot of, like, let's say, again, don't take me on the face value, but, a lot of interest on this crypto stuff here. Abhi that thing swings 30-40%, underlying क्या है, क्या नहीं है, क्यों करना है, कुछ समझ में नहीं आता है, but there is a lot of craze. I was talking to my nephew when he was studying in US. I said, okay, now he got a job at Toyota. So I said, okay, अभी इंडिया भेजो पैसा, आप SIP शुरू कर दो. मामा, I will do cryptos over there. तो अभी वो cryptos कर रहे हैं. Right.
But crypto is big in the US.
Abhi now it's different, but yet, I mean, will you put? Or how will you put? How do you decide when to buy, when to sell, all that stuff?
Because the legalities are a bit vague
exactly,
in India.
Something which is not regulated.
If there was a regulator, I would put, for sure.
I will also put, but right now I don't have the guts to put. But I'm just saying, simply put, don't, in the initial years when you're building your portfolios, there will be a time when you can take that risk also. When you have enough money, you can put 5-10% and take a risk. वो zero हो जाएगा तो चलेगा. It will not impact you. But when you have only as much, and in that it is a very high risk. And if that becomes zero, I've seen that it is hell. Right now I'm laughing about it, but when I went through it, it was pain. In 2008, when I lost in that IPO, I took my wife and I said, I've lost everything. And then I went to Mangifera, on 5th Road, and she motivated me. And then, then I started the painful journey of SIP. And now that portfolio looks good.
So you invest all your money in the funds only?
All funds, and that too all Motilal only.
हाँ, obviously, yeah.
वही समझ में आता है तो उसी में डालते हैं.
And compliance भी है ना?
Compliance mutual funds के लिए इतना नहीं है. Compliance is more on stocks.
Okay.
And उतना time नहीं है what to buy, what not to buy. I know what my managers are doing. Pretty good portfolios. Just put money there and focus on your work. See, our focus, non-fund managers, non-equity investors, our focus should be to make money, earn money. Out of that, some portion you give it to professional for a small fee and let them make the money work for you. तो आप नहीं तो क्या कर रहे हो, आपने आपका core work को छोड़ के उसमें then the moment you buy stocks, when I used to buy stocks, is that 24/7 you are on money control and seeing the ticker up and down, ऊपर and नीचे. फिर sometimes you're excited, sometimes you're more demotivated because it's happening up and down, right? So then how much of your focus is deviating from the core work? Let's say if this is your core work, content development, and sitting in this interview, your head is in the ticker, what's happening on my portfolio. It will distract you.
So the same thing happened with me actually. I used to invest a lot in direct stocks back in the day, 10 years ago. Eventually I realized that compounding will happen at 12, 13, 14%
Bas,
max,
bas.
whatever you do.
And you're
But
happy.
in direct stocks, actually, you have a chance to lose a lot more
Yes, yes,
than you lose in
yes,
mutual funds.
yes.
So
In-
then
in-
I
yeah.
largely, I mean, I still have a direct stock portfolio, but largely I wrap that up and I,
Yes,
just. And
absolutely.
then eventually I moved from a lot of active funds to passive funds only.
And now, when you have slightly sizable coppers, there are so many alternate managers giving you very boutique stuff, non-mutual fund. See,
Yeah.
mutual fund is a very mass vehicle, very tightly regulated, right? So don't. It's like a no-nonsense kind of a thing. I mean, वहाँ डालो, shut it, fill it, forget it वाला story है. But now you have PMS, you have AIFs, you have private equity, you have venture capital, you have private credit. So once you have a sizable portfolio, then some part of the money you can do that, and that will give you still more boutique portfolio than a mutual fund portfolio. आप PMS कर लो तो आपके डीमैट में आ जाएगा. It's just
Correct.
that if you don't have the skill to decide what people who don't have knowledge buy stocks on price. People who have knowledge buy stocks on fundamentals. So when you buy on price, everything is on price, and why the price goes up, why it goes down. If you don't have the understanding, you will make mistakes.
Correct.
But if you understand the value, then you, even if it is down, you will hold on. नहीं भाई, this profit बढ़ रहा है इसका, ROE बढ़ रहा है, market share बढ़ रहा है. That is what the fundamental investor is. That is what the fund manager is seeing. He is hardly, I don't see my fund manager fretting over prices. They are fretting over quarter का number कैसा आ रहा है. Right? So the mindset changes.
It was really fun chatting with you. We've run out of time, but as you suggested, we're going to do a part 2 where we're going to discuss a lot more things, whether it's international investing. You guys are doing a lot through Gift City as well.
Yeah.
And of course, a lot more on the mistakes that you've made. I'm waiting to hear those. But Akhil, thank you so
Thank you.
much for joining
Thank you
us
for
on
the
the Money
opportunity.
Mindset.
Thank you for the opportunity.